You're listening to certified financial planner Doug Goldstein, host of the Goldstein on Gelt show, www.goldsteinongelt.com.
Okay, I'm very excited to have on the Goldstein on Gelt show Tobias Carlisle, who is not only the founder and managing partner of Carbon Beach Asset Management, but he wrote a fascinating book called Deep Value: Why Activist Investors and Other Contrarians Battle for Control of Losing Corporations. Now, Tobias, you're the kind of guy who looks for value, and it's even in the title of your book, but I think a lot of people listen to this term, they say, well, of course I'm a value investor. Why wouldn't I buy something that's a good value? What is value investing really all about?
In its very simplest format, it means trying to buy book value or earnings or cash flows at a low multiple. That's the idea that Benjamin Graham promulgated in his book, Security Analysis. The idea has been extended by Warren Buffett, who says that you can do this calculation where you value a company like a bond and you look at the cash flows from here until kingdom come. You discount them back to today, and if you find that the stock is trading at a wide enough discount, which value investors call a margin of safety, then you can purchase that stock. So it's an assets and income cash flow test, and it's worked fairly well.
Okay, so those are a lot of terms to use. We're not going to be able to break all of them down, but let's talk about this future cash flow, because the only cash flow an investor gets when he holds a stock is the dividend. Because unless you sell it, there's no profit. There's only two ways to make money on a stock. You buy it and you sell it for a capital gain, or you get a dividend. So does that mean if you're valuing for cash flow that a real value investor would never buy a stock unless it pays a dividend?
No, not at all, because you have a book value there and you have an asset value that's offset by some liabilities. So you're seeking to buy as much asset value as you can. But the cash flows that come into the company, hopefully they're redeployed in a sensible way and the company grows over time. That sort of compounding of the cash flows that come in added to the existing assets, that grows the underlying business. So in one sense, you have to think about it in two different ways. You think about a stock as a share in a company, and that company owns some assets and a business which generates some cash flows, and it's you're trying to buy at a discount, and then hopefully you get some growth as well, so that you don't necessarily need the dividend, and in many instances you might not want the dividend for tax purposes or because it's better in the hands of the management because they're growing at such a high rate.
Okay, so if you're not necessarily looking for a dividend, what about revenues? Would the company have to have revenues?
No. So this is one of the things that makes a distinction between deep value investors and franchise investors, or investors who are more like Warren Buffett. So Buffett is looking for a very good business, and he wants a management that can grow that business over time. And the way that he describes a very good business is one that has a very high return on invested capital. Basically, that means it makes lots of money for the amount of money that management has, or the original founders of the company have invested in the company. Guys like me who are deep value investors, and this is more towards the Benjamin Graham, more classic traditional style of value investing. You're looking more for an asset value, and sometimes you can find a very substantial asset value with either a business that's not worth anything at all, or it could be worth less than nothing if it's losing money. In those instances, if it had no revenue, it'd actually be worth a little bit more, because that would mean that the business was no longer being conducted. And so you buy it at a discount to value, and then you hope that either management liquidates the company or it attracts an activist who gets on the board and causes the company to be liquidated.
I can't say that I've seen a lot of companies liquidated in my careers. This is not a common thing, right?
It's not uncommon. If it's the sort of thing that you're searching for, and when you're looking for these companies, they are always going to be very small companies, but it's not uncommon. And in a market like this, there are fewer of them because the market is very strong. It's easy to raise money. It's easy for businesses to lose money and then raise it on the public markets or even from venture capitalists. So a lot of that pressure is taken off them. But in a 2007, 8, 9 type market where it's very difficult to raise money, very difficult to raise debt as well, you'll see a lot of liquidations, and you'll see companies trade at a big discount to that liquidating value, and you can make very good returns investing in those.
We're talking with value investor Tobias Carlisle, who wrote the book Deep Value. He's been explaining to us a couple of interesting points, which is that a value investor is not necessarily going to require a company to pay a dividend before he buys the stock. He's not even going to necessarily require a company to have revenues before he would buy the stock. Tobias, you describe it as you're looking at the asset value of the company. So if you can buy an asset, if you can buy a dollar for cheaper than a dollar, it's a good deal. Can a normal investor just go to Yahoo Finance and look up the book value of a stock, and then if the book value is higher than the price that it's actually trading on the stock market, go ahead and buy that and wait till a contrarian comes along and takes part of the company to get that value out?
Yes, they could, but the better metric, and this was one that Benjamin Graham identified, is the net current asset value. And what he was looking for there was cash. That's the most liquid asset that a company can have, and that's the one that is the best for it to have. But it also means its receivables or its inventory, and those are discounted a little bit more than cash. Cash is worth 100 cents on the dollar. Receivables are worth slightly less, maybe 85 cents on the dollar. And then inventory depends on the inventory, but maybe 50 cents, maybe 30 cents. And you conduct this valuation where you work out what those things are worth. Then you find all of the liabilities, all of the debt, and you deduct it from that net current asset, from the current asset amount to get the net current asset amount. And if you can then buy the company for 2/3 of that net current asset value, then that's something Benjamin Graham recommended doing. There are very few of those companies around, but the historical returns to them are excellent.
When you say very few, does that mean there are 4, or there are maybe hundreds, but you just have to know how to find them?
It depends on where you're looking. Globally, there have been sort of between 1 to 300 pretty consistently over the last 7 years, although there are fewer now than there were last year or the year before. In 2009, at the very bottom of the last crash, there were 1,000 or something like that available, and they had a very good return when the market did finally recover. But they also did fairly well through that period, because there are activists and people who are running those companies who are liquidating, and so the money is coming out, and you can generate a little. That's a catalyst. You can generate a little bit of a return, even though the stock market is falling.
Mm-hmm. A lot of people are out there calling themselves value investors, and they have some, dog and pony show that they'll do to say why they're looking for value, but they do poorly. When you follow a lot of these companies or these managers, they don't do well. What are the mistakes you think that they're making that's causing them to really underperform?
I'm always very careful criticizing other value investors, because it means that you're just about to go into a period like that yourself. But It has been a very difficult period for value over the last 7 years. It's been one of the last period of underperformance like this was the late 1990s, and then that was led to a very good period in the early 2000s. Through this period, value has done okay. It's just that the market has been so strong that the relative performance isn't great. But one big mistake that I see, and that I've sort of shown quantitatively to be an issue, is overpaying for return on invested capital, overpaying for growth, because businesses don't exist in a vacuum. They've got competition that desperately wants that very high return on invested capital, because it means you grow very quickly without putting too much into the business. And so these businesses are assaulted all the time by their competitors, or companies in adjacent industries, or startups that are very well financed. And that return on invested capital tends to mean revert. Also happens on the other side. Poorly performing companies, lots of the competition leaves the industry, or they just fold because it's so tough to survive, and they tend to do better. That's why deep value investors do quite well, looking for those companies that look like they're in a bit of trouble, but they can survive because they've got the balance sheet value there. And you get that improvement in the business and the sort of narrowing of the gap between the discount to value. And so you get this basically 2 ways to win, which is why I prefer deep value.
Tobias, I have so many questions for you. I'm wondering, how diversified should someone be who does this? And what are the tax consequences of being a deep value investor? What sort of portfolio should someone try to buy in when? But we are just about out of time. So in the last few seconds, tell me, how can people follow you and follow your work?
I'm on Twitter at Greenbacked, Greenbackd. The website Acquirers Multiple. I won't spell that for you, but it'll be in the show notes. That has some of the stock picks that it's a screener. There's 1,000 in the top 1,000. It chooses the best 30 in the US on this metric. And my books are available through Amazon: Deep Value, Concentrated Investing, and Quantitative Value.
Okay, we will put links to all of that at the show notes of today's show at goldsteinongelt.com. Tobias Carlisle, thanks so much for taking the time.
It was a pleasure. Thanks, Doug.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.